Hi, I'm Paul Feinberg. I'm host of UCLA Anderson's podcast. I'm here today with Professor Stuart Gabriel. Stuart is the UCLA Anderson's Arden Chair in Real Estate and also the faculty director of the UCLA Ziman Center. We'll be talking today about commercial real estate. So Stuart, today we're going to talk about commercial real estate. In the past, we've talked about residential real estate, and I think to generalize, maybe more people know the issues in residential. They're homeowners or they want to be, so they follow mortgage prices and home prices. But in talking about commercial real estate, maybe you could kind of begin by just set the stage briefly and tell us, what are the issues for those in commercial real estate? What types of data and things do they look at and do they follow?
Paul, it's always a pleasure to have a conversation with you. Happy to join you this morning. We look at a variety of indicators in commercial real estate. We basically look at anything that relates to vacancy or income or construction trend in the form of starts of new construction, and of course we look at rents, so that there's a whole potpourri of indicators that are pertinent on the commercial side. Okay, so with that as the table is set, so maybe take us back a little bit. Where was commercial real estate? Where has it been? And kind of bring us up to the present, and we'll talk about the present and where we're going. Okay. Paul, you know, when you and I spoke last, as you mentioned, we spoke about the residential sector, and at that time I characterized residential generally as sort of the tail that wags the dog, not really the dog that wags the tail, but this idea that the residential sector as a component of GDP was actually quite small. It was really only about 4% of GDP, but residential real estate is a leading sector, at least traditionally. It's also a very interest rate sensitive sector, and we often follow the residential sector both into and out of recessions. We see at this point in time a little bit of strengthening on the residential side, but yet quite weak, and we're really unclear about the path of the economy at this moment going forward. But that notwithstanding, commercial real estate is not a tail that wags the dog. Commercial real estate is a lagging sector. It has lagged the economy very significantly going into a recession. Commercial real estate is in recession at the moment, even as the rest of the economy emerges from recession. There's a lot of risk to the economy at the moment associated with commercial real estate. We don't at this moment believe that things are so bad that the economy will double dip because of commercial real estate. But that notwithstanding, we're going to see weakness and dislocation in this sector for many months, if not quarters or years to come. Now let me wind us back a little bit, then we'll go forward and we can hone however you wish. Winding back, we have of course had a Great Recession. It hasn't been the D word, it hasn't been a Great Depression #2, but it has been quite severe as we look back over the post-World War II recessionary periods. And it's been severe for a number of reasons. One has been that we have literally drained all the oil out of the crankcase, and we're now trying to put some liquidity back into the crankcase. Of course, you know what I'm referring to. I'm referring to the capital markets. And I'm referring in the metaphor of looking under the hood of your car, that you cannot drive your car without oil in the crankcase. So pretend, in terms of this metaphor of your car, that the cylinders in your 4-cylinder Prius or your 12-cylinder Thunderbird, I'm not sure what kind of car you drive, but somewhere in that range, pretend that those cylinders are the sectors of the economy, and that those cylinders are embedded in a crankcase, locked in a crankcase, where we pump a lot of liquidity into that crankcase. Occasionally you take your car to Jiffy Lube, you take the plug out from the bottom of the crankcase, you drain the oil, you open the top of the crankcase, put new oil in. In this case, in the case of our Great Recession, with the massive dislocation in the capital markets, we basically opened the plug under the crankcase, we drained the liquidity out of the crankcase, and we've had great difficulty filling the crankcase back up. We've had great difficulty opening the capital markets and putting that necessary liquidity back in. Well, commercial real estate today, at this moment, is suffering from severe illiquidity. Commercial real estate over the course of the last 2 decades has come to depend very, very importantly on non-bank sources of finance. And that means Wall Street, and it means securitization markets. The securitization markets for commercial real estate, what we call CMBS, commercial mortgage-backed securities, as well as upper levels of securitization, what we call the CDO market, the market for collateralized debt obligations. Those markets have closed, and they've essentially been closed now for over a year. And this has denied commercial real estate a primary source of liquidity and has made for great dysfunction in this market as we try to heal this market, as we only see little bits and pieces of liquidity that are sort of moving back into this sector. Let me explain. Maybe about a third of commercial real estate debt is held today in the form of securitized product. And what that means is that financial institutions or Wall Street will take a commercial real estate loan and they will create a security where the cash flows from that loan back the security, and they will sell that security along with the expected cash flows to investors. And this again has been a primary form of renewing the supply of loanable funds in commercial real estate markets. As we went to more exotic forms of securitization, as we went to what we call re-securitization, where we took existing CMBS and retranched and re-securitized in the CDO structure, and as the market fell out of those structures, starting with subprime residential mortgages, but then migrating to the commercial side, we've seen a terrible, even overreaction in that sector with respect to the marking down in security values, huge gaping increases on spreads on those securities relative to some benchmarks such as the U.S. Treasury, and with that very sharp, difficult downward adjustments in the valuations of debt and the valuations of equity, that being the property itself, that would be dependent upon that debt. So one major force for downward adjustments in commercial real estate has been the lack of liquidity. Now let me go from the lack of liquidity to other factors. Strain from what we call the financial side to the real side, we've also seen, as we've just remarked, a terrible economic downturn. And the real side indicators feed directly into the commercial side. So let's take commercial real estate, which is big and amorphous, and divide it a bit into pieces that are more amenable to analysis. And when we do, let's talk about the office sector. Let's talk about the retail sector. Let's talk about multifamily residential. Let's talk about warehouse and industrial. And if you want, we could talk about hotels as well. Let's start with the office first. If you break things down to their simplest form, office revenues, office development, the profitability of ownership of office structures, and the like, are driven by one simple determinant, and that is the health of our labor markets. Our labor markets today, as you know, are extraordinarily unhealthy. We've lost 8 million jobs in this Great Recession. Many of them have been associated with individuals who work in offices. And with that, we have certainly today, looking forward, as you know, as our colleague Ed Leamer speaks to in the context of the UCLA Anderson forecast, we have an expectation of a relatively jobless recovery. In other words, we have a technical recovery in GDP. GDP is growing. We will technically be out of recession. But that doesn't translate immediately to job growth. It translates only with significant lag. Our chairman of the Federal Reserve, Ben Bernanke, has told us that the best we can hope for in the near term is a slowing in the rate of job contraction. So the labor markets are still ailing. They're still bleeding. We're still losing jobs. We're yet at this sitting to see any evidence of job growth. We hope to see some in the near future, but if you follow the UCLA Anderson forecast, you know that even If we were to meet 2 years from now, we would expect to see the unemployment rate still in the range of 9 to 10% for the United States, and even higher than that for California. So that we expect only modest and slow healing of labor markets, only modest and slow job recovery. And what that means is that the office sector for some time will likely be plagued by declines in net operating income that are associated with higher levels of vacancy, that are associated with lower levels of rents, and that, of course, the valuation of these properties above and beyond that, as I've suggested, are suffering owing to constraints in the capital market. So all these factors coalesce and make for great difficulty in the office sector. Now, the other side of that coin, Paul, interestingly enough, as you would expect, is that there's neither a glaring fundamental demonstrable demand at this moment, nor is there the capital to finance new office development. So what's going to happen, and what already has happened, is that if you look here at around the LA metro area or many other metro areas in the country, we're not building any office product, nor have we for some time, nor will we for the foreseeable future. And so at some point, 2 or 3 years down the road, we're going to wake up and we're going to say our office buildings are all full, we have no new product, and we will see, the other side of this cycle. And that will be higher rents, lower vacancy, higher valuations, more liquidity, et cetera. So the cycle will come back. It may come back with a vengeance, but it's not as if we're planning today for the new product that will be associated with growth in our labor force 2 or 3 years down the road. Anyway, that's a quick tour of the office sector, and again, the linkage between prosperity in the office sector and that associated with the labor market. If you go from there to another of our favorite sectors, and especially at this holiday period, that being retail-oriented real estate, a primary sector of commercial real estate, again, we see a sector which is currently on its knees, but with some hope for improvement. And again, the easiest way to think about retail real estate is to think about the fact that retail real estate is driven by retail sales, and retail sales are driven by the health of the U.S. consumer. So it's almost as simple as that. So go back again to the economics and to the economic forecasts with respect to the health of the consumer. And there again, you find a very mixed outlook and the likelihood of a slow and somewhat troubled recovery. So if you talk about consumer spending and you drill down into the primary components of consumer spending, firstly, there's current income, and secondly, there's household wealth. Wealth either in the form of financial assets, some of those in pension form, and of course, in the form of home equity. Well, let's take a look at all of those components. Firstly, household income. Well, income is driven by employment. And with the labor markets being as weak as they are, household income, just current income at the moment, is weak relative to recent historical standards. But what about the wealth side? Well, the wealth side's been hammered. It's been hammered by huge downward reduction in home equity and inability in this moment for households to extract home equity for purposes of supporting consumer spending. We had in prior years, in our so-called bubble years or our boom years of mid-decade, we had very significant amounts of consumer spending and hence support for retail real estate that derived from the housing sector. Here, the linkage between residential real estate and commercial real estate. Home values were going up and up and up, and it was easy to extract that wealth with home equity lines of credit. And with that, we saw significant consumer spending. Today, we have what's called not a positive wealth effect, but a reverse wealth effect, where the combination of the contraction in home equity, coupled with the inability to obtain a home equity line of credit for many households and extract whatever remaining wealth exists, is, of course, reflected in weakness in consumer spending, weakness in retail sales, and with that, weakness in rents and elevated vacancies and diminished profitability of the construction and holding of retail real estate. Now, when you look at the outlook for the consumer, taking it all the way back and bringing it forward, again, that outlook is mixed. Maybe many of the baby boomer cohort members have been hit hard with respect to their retirement accounts and have to look to do whatever they can to begin to assure very belatedly and with great problem the solvency of the household in retirement, which may be looming in 10 or 15 or so years, not so far down the road. As we mentioned, financial assets have been hit hard, and we've mentioned that the housing asset has been hit hard. Many households, of course, have stocked up on all kinds of debt over the course of the recent boom period, so that household debt levels continue to be extraordinary by any historical measure and are just now being pushed down by households in the context of this difficulty of Great Recession and current recovery. I think it's suggested, Paul, in life generally and perhaps in the economic behavior dimension of life, that sometimes we only change behavior in the context of a major shock. And it took this major shock to provide the impetus for a change of behavior. And we're seeing that now as households pay down some debt, are less prone to incur debt, are less able because of the constraints in capital markets to incur that debt. And we're seeing that baby boomers who across the entirety of their lifespans have failed to behave are now beginning to behave a little bit better with respect to what you and I might call responsible retirement planning. So anyway, going back to the retail real estate, we think the Christmas spending season is a better one. We have some early evidence that it is relative to last year, a very difficult year. There is more confidence in the air than there was a year ago, and our measures of consumer confidence say that we've clawed our way part of the way back up. Consumer confidence plummeted to the lowest levels on record at any time since we've been measuring confidence, and relative to the sort of post-decline levels of confidence, we've come back currently about a third of the way. We're still about 2/3 down. So we're still with very shaky confidence, but that notwithstanding, the stores seem to be doing better. People have a sense that we're on the road to recovery, that we've sort of caught this falling dagger, that there is a tomorrow and there is a brighter tomorrow. And guardedly, we expect retail sales to do better. But that notwithstanding, as you well appreciate, there have been many consolidations in the retail industry. There are many retail centers around the country that have very significant levels of vacancy. And there are many holders of retail property, owners of retail property, institutional owners of retail property, or owners of debt associated with those retail property that are suffering greatly at this moment and have had to incur great write-down and great loss. So that, in a nutshell, is the retail sector. Those are the primary sectors. The hotel sector varies with both the consumer and the business traveler, depending on whether we're talking Maui or we're talking the airport Marriott at LAX. Obviously, the Maui site being much more oriented to a consumer vacation traveler. The consumer side is, of course, weak for all the reasons we've described. The business side is slowly coming back. But hotels are another terribly ailing sector. You would think that multifamily rental would be a great place to be in today's real estate market as we see record levels of default, foreclosure, short sale, and the like. And we actually have very large numbers of households that are pouring out of ownership and into the residential rental sector. And indeed, some rental properties are doing okay. But the rental sector has also been hit hard by the recession. The rental sector here in LA and in California more generally has been hit by outmigration of population outmigration of labor force. We even see perceptible numbers of migrants from Mexico, from Central and South America, who in the context of a relatively bleak set of opportunities have returned home. So actually, vacancy rates are up even in rental real estate, and this particular moment is not a great moment. We also saw, as I know you recall from our prior conversation, great oversupply of condominiums. And many of those condominiums have been converted to rental structures, and that has added to excess supply in the rental sector. So we have a variety of factors there that make the rental side of commercial real estate less attractive than it ordinarily is. But again, population growth and resumption of economic activity and the like should make for relatively firmer fundamentals in this sector going forward. So that's some review. Why don't I stop there and we'll let you hop in here.
Okay. For lack of a better way of describing it, you kind of described both the Wall Street issues facing those in the commercial real estate sector, and then the Main Street, the real world kind of issues. If I'm an owner of either a malls or office buildings, am I more concerned about this lack of liquidity, my ability to buy and sell the property I own, or am I more concerned about the business side, my renters' ability to pay their rent, and the store owners who are renting from me ability to sell their goods so they can make rent? Which is a greater concern to owners of real estate?
Paul, that's a very hard question because at this moment both are of grave concern. Typically speaking, the debt that would be put onto a mall or would be put onto an office building would be interest only, it may be non-amortizing, and it would be due often in 5 years. So it would require rollover within a 5-year period. For many owners of property today, that rollover is not possible. So they are in negotiation with a lender. Sometimes we call this extend and pretend. We have all sorts of funny ways of describing this in the real estate industry today. But the lack of liquidity has knocked many lenders out of the business, or is reflected in many fewer lenders. As I mentioned previously, it's reflected in a lack of activity in Wall Street. And what this means is without the debt, as we say in economics, the demand curve shifts in. There's fewer potential lenders, there's fewer potential buyers, and what that means, holding supply constant, is that prices fall. This is, so this in and of itself is highly problematical if you are an owner of such property. And then on the fundamental side, your fundamental indicator of income, what's called net operating income, is driven largely by two factors, by rents and by vacancy. And in that particular respect, oftentimes the way you've written a lease contract is that there is a base rent and there is an increment to base rent that is based on sales in the retail space. So that, as you can well imagine, during a period when those sales are off by 20 or 30, whatever percent, rental income falls, NOI falls. Of course, the vacancies accumulate. And so both the fundamental factors and the capital market factors are very troubling to institutional owners of property at this moment.
Is there an upside for the people on the other side of the equation? What I mean is, if I were in a business that used office space or was in a commercial venture that used retail space, is now the time for me to be finding great bargains in rent, great bargains in finding stores, expanding my stores because I can get nice locations in strip malls that are empty? And is that a benefit to the other people in the economy?
One would say yes, one would hope so, and one would, this is our fundamental supply and demand mechanism at work, the mechanism that you described. So just as today is perhaps a difficult time to sell a home, if you have financing and you have cash, today might be a wonderful time, as we're close to bottom, buying a home in many areas, at least areas that are not grossly overbuilt or areas that are not going to be subject to major foreclosure and short sale activity. But of course, with a downward adjustment in price, there's an opportunity there. And there's certainly an opportunity for those who seek space, who seek to expand their operation, are looking to drive a bargain in the office sector. Today is a wonderful time to negotiate for space. You can get space at significant discounts, plus many months of free rent and all sorts of other opportunities that would not have been available previously. So the answer is yes, and we hope that the lower prices and the liquidity that will come back into the system and the major attempts by the Federal Reserve to push liquidity back into the system and fiscal stimulus that might ultimately create a few jobs and the like would all be helpful to allowing the sector to move out of its current weakened state.
So the construction sector is a cousin or a relative to the real estate sector. What's the impact been on construction? You spoke earlier that we're not building as much. So what are the people on the construction side doing? Are they waiting now for the need to go up? What's happening there?
What's happening is that anyone who works in the construction area is having great difficulty. And that's true on the residential side as well as the non-residential side. And it's true for publicly traded and, of course, non-public entities. The public entities, as you know, have seen their stock prices absolutely beaten into the bargain basement area, owing to the fact that it's very difficult to run a public development firm in today's market, given the extreme paucity of development activity. And there's, many workers have left this sector. There are very few construction jobs. What one would hope is that the fiscal stimulus in its usual format would push infrastructure spending. And this is, of course, in many cases, infrastructure that we need in the most significant way as we look to create an opportunity for the government to provide leverage for economic growth going forward. And so one would hope that construction associated with major infrastructure projects, be they rapid transit or the like, and of course we have great need for that here in LA, Paul, and as you know, we're trying to put a rapid transit system into Los Angeles, that would provide jobs, that would create activity for major construction firms, and that would carry us into the next phase of the recovery.
Okay, so we're taping this just before the Christmas break, and people will be able to start viewing it in the beginning of the year. And I want to leave people with optimism and hope for the new year. So let's look a little bit towards the future. I can tell you, I live in West Los Angeles, and they just opened this beautiful new mall or reconstructed mall in Culver City, the former Fox Hills Mall, which is now, I don't know the name of it, but it's this beautiful new mall, and it's very shiny, and it gives me hope that things are turning. So what can we look for in 2010, maybe even 2011? Where are the signs of hope, the rays of light for those in commercial real estate?
The rays of hope are associated with the glimmers of a job recovery. As I mentioned earlier, it will likely be slow, but we already see very sharp contraction in new claims for unemployment insurance. We still have a double-digit unemployment rate, but for the first time, it's started to come down some. The Federal Reserve is going to continue to provide liquidity. We expect to see ongoing stimulus-related job creation. Consumer confidence, as I've mentioned, is improving in some measure. It's got a ways to go, clearly, but there is a sense, I believe, on your part, in your family, certainly in mine, again, that we are not imploding as we were maybe a year ago. Again, that we've caught the falling dagger. Our hands may be bloody, but we have arrested the free fall. In fact, we've turned the cycle around. In fact, we are moving in the right direction. And as much as baby boomers are perhaps behaving a bit better. My understanding is discretionary spending is returning to the system. People feel better this holiday season than they did a year ago or thereabouts. So we look for gradual but ongoing healing, and I think that is across the board, the forecast, and that gradual and ongoing healing ultimately will put workers back into office buildings, will put business travelers back into hotels, certainly will put consumers back into the malls, and with that, commercial real estate will return to some semblance of its former self. I should say as well on the capital markets side that the Federal Reserve, through a program called TALF, has succeeded in helping to provide liquidity for the first new securitization of newly originated commercial debt. This is only the highest rated piece of that securitization puzzle, so to speak. That's the AAA piece. But that notwithstanding, it is an indication, as I suggested earlier, of some liquidity coming back into the commercial real estate crankcase. And so we can be hopeful as well that there will be a combination of economic fundamentals and dribs and drabs of liquidity that will basically help us to heal.